In this video, we're going to talk about 3 risks that private equity fund investors face when building a private equity fund program. Those risks are vintage risk, industry risk, and geographic risk.
Number 1 is vintage risk. Just like a bottle of wine has its vintage year when its grapes are harvested, a private equity fund has its vintage year when its capital is raised. If you're a private equity fund investor, one of the most important things you need to do is look at the vintage of your private equity funds and make sure they're diversified. Let me give you a couple examples why. Let's say you invested in a private equity fund in 2009, after the financial crisis. If you invested in 2009, multiples were low. And so the private equity fund would be buying companies in 2010, 2011, and 2012, and probably getting pretty good deals on the company and probably had pretty good performance over the next 10 years. Let's contrast that where if you invested in a private equity fund in 2005. If so, the private equity fund would be buying companies in 2005, 2006, 2007. During that period of time, multiples were at a high, and it was before the financial crisis. And so if you invested in a fund at that time, you would have to hold those companies through the crisis, and one could argue you may not get the same positive returns you would if you invested in a different vintage. And so, if you're a private equity fund investor and you're looking to build a private equity fund program, make sure you diversify across vintages. The second risk that private equity investors need to look at when building a private equity fund program is industry risk. When building a private equity portfolio, an investor needs to be aware of the entire portfolio and the industry breakdown within that entire portfolio. When looking at the private equity portion, investors need to look at how the industry breakdown in that portfolio is going to affect the overall industry exposure for the entire portfolio. Once that's clear, then the private equity fund investor can develop a strategy to either focus on industry-specific private equity funds or more general private equity funds. The third risk that private equity fund investors need to look at when building a private equity fund portfolio is geographic risk. Similar to industry risk, when looking at geographic risk, investors need to look beyond the private equity portion of the portfolio and to look at the entire portfolio. In regards to geographic risk, there are many risks, including political risk and currency risk. Let's talk a little more about currency risk. If an investor invests in a private equity fund that has a high IRR, but the IRR was achieved in a currency that was devalued, well, the IRR might not be as great as it seems.
In this video, we talked about 3 risks facing private equity fund investors when building a private equity fund program. Those risks were vintage risk, industry risk, and geographic risk. Can you think of another risk facing private equity fund investors? Please leave a comment below.